Alright, so today I have a few questions for you. The first one is, do you think that Justin Trudeau can win the election even with the blackface thing? Do you think that we'll have pipelines if Andrew wins it? Or do you think that we will lose all our infrastructure power if Jagmeet Singh wins the election? And most importantly, do you really think that Nick Suzuki can play on the second line for the Habs this year? Yeah, don't worry. I'm not going to go political or play hockey today, but I thought it was a cool intro. So now, let's see how you can position your portfolio when macroeconomic events threaten or should boost your investment returns. Let's roll the intro. Dividend investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rock and passionate investor. Today I'm answering Steven's question, probably not Stephen Harper, obviously, about the upcoming election in Canada and how it could affect your portfolio. Steven's question basically was asking, well, Mike, what will happen with my portfolio if Justin wins or if Justin loses, and so on. And it creates a lot of uncertainties. And I thought, I'm not going to go political today. I'm not going to go into the Canadian election either. I'm going to bring this question to a broader horizon, is how can you position your portfolio to enjoy or protect yourself from macroeconomic events? What's happening is Fed decisions, commercial trade wars, recession threats, elections, all those macroeconomic events will dictate the flavor of the day or the week or the month, right? So basically see those news as a narrative for the news cycle. So yeah, right now we have like some strong narrative right now that will influence what's happening on the stock market. We have election in Canada, we have the trade war in the US, we have the upcoming election in 2020 for the US. Basically, we have recession threat in Europe. We have the inverted yield curve and negative yield bonds in the Europe as well. So all those macroeconomic events are either generating hype or fear around the market. And I must say, first, it is very, very difficult to determine what will be the outcome of a potential event. So we don't know what's going to happen with the trade war, for example. We don't know who's going to win the election. And then it's even harder to determine what will be the outcome of that event. So if Justin wins, what's going to happen in the economy? If Andrew wins, or if the trade war ends tomorrow morning, what will be the impact? And sometimes it could even be counterintuitive. The results may not what you think it would be. And I have a very good story about it. I keep discussing the market with one of my friends who's a passionate investor like me. And I was telling him how I was surprised to see how the market reacts when the Fed increase or decrease the rate. The thing is, the market will have its own expectation. So on day one, with whatever happens in the economy right now and with the latest information that we had from the Fed, the market will determine, we think that the Fed will not touch its rate next quarter. And after that, they may drop it by like 25 to 50 basis points in the upcoming 6 months. So that's their expectation. So they price the whole market, the whole stocks with those expectations. And then the Fed happens and they just say, we think the economy is doing well, blah, 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 inflation, blah, blah, blah. And that's just a statement. They're not telling you what they're going to do with the interest rate, obviously. This is pretty much what we have like on a monthly basis. And then the market will react to that statement and they will adjust their expectations. So sometimes they will get bullish, sometimes they will get bearish, depending on what's happening and depending on what the statement is saying compared to their previous expectation. And then the whole thing happens again. So this is why most of the time when the Fed comes out with a statement on the economy, we have market movements. And then when there's the real decision happening, when the interest rate goes higher or decrease, it also comes with another statement. And then the market will readjust once more its expectation. So basically what I'm trying to say here is as a macroeconomic event evolve, as we get more information, the market is continuously adapting upward or downward their expectations. And this is how it creates so much volatility. If you want to make sure that you see volatility in the market, look for uncertainties. And macroeconomic events are full of uncertainties. When the trade will end, how it's going to happen. Will the US win? The Chinese win? Everybody lose? All those outcomes, will there be like potential tariff forever? So all those potential outcomes are very difficult to price in the market, and every single day someone is making new assumptions based on new information that we receive. So basically, my advice on that is not to position your portfolio to either enjoy a potential outcome of an event. Like, for example, if you're betting on the election and you think that the Conservative Party will win, well, chances are the Conservative Party will be better for the oil industry, right? Since we have a strong oil industry in Canada, increasing your exposure to this sector could be a good bet. But if Jagmeet Singh wins, then you're really in the left field and you're probably going to lose a lot of money. So you don't want to play that because the outcome, we don't know what's going to happen. So I don't think it's a good idea. For me, this is not really strategy. This is more like going to the casino. However, there is something you can do. And this thing is called having a buy list. And I'm going to give you another example with that. At DSR Pro, we review over 1,000 stocks each quarter. As the trade war was happening in the past, 12 months, we saw a huge slowdown in the semiconductor sub-industry of the technology sector. So what we did is we started increasing our rating from hold to buy to many of those companies. We were looking at strong companies with strong business model, using all the DSR stuff as usual, all our investing principles. But now what was happening is all those semiconductors companies were at the end of the investment cycle. And on top of that, we had the Chinese trade war going on, hurting their revenue and their guidance. So all those stocks were now priced for a recession. So what happened is they all lost 10, 15, 20, 25% of their value within a few months. And then when you look at those companies, there were strong companies and you know that the trade war won't be there forever. So we raised them to the buy section. And then if you buy them, now you can see that the sky is getting clearer, clouds are getting away a little bit, and we all know that the market has already priced that for correction, and the semiconductors are not thriving, but they're recovering right now. So this was a really easy way to enjoy what's happening in the market and to position some of your tactical buys according to a macroeconomic event. So right now, if we look at what's happening in Canada, you can have on your buy list, if you have some energy stocks, for example, that are being hit and hurt with everything that is happening, and you still like them, and there's a strong investment thesis. So you don't go in the energy sector because you think you're going to win your election. Go in the energy sector if you already have companies on your buy list that has strong investment thesis, but you weren't not too sure about the price. And then when you see a great company losing 20%, 30% of their value, then it's probably time to pull the trigger and to buy some shares. So just to be clear, I'm not telling you to go in the energy sector because you think you're going to win the election. I know I'm repeating myself, but it's very important. What I'm telling you is you should always have a buy list ready. You should always have a list of stocks that you like. You can use DSR buy list if you want and track those companies. If they are getting affected by whatever macroeconomic events that is happening at this time, then here's your entry point. Here's your buying opportunity. It's already a good company. You already made the analysis and you like it and everything. And then you have an opportunity to buy it with a 25% discount. Why not do it, right? So this is more the way I would use macroeconomic events to position my portfolio. And honestly, if you want to protect yourself, if you want to protect your portfolio against any possible outcome that could happen in the next couple of months or a couple of years, I'd say that the best protection is to make sure that all your holdings are very strong companies with strong balance sheet showing revenue growth, earnings growth, and dividend growth. And if you're not sure with this kind of strategy, well, probably that's your best bet then is to stay in cash, buy some bonds, and never go back in the market. Because uncertainties will always happen. Volatility will always happen as well. So what's going to happen now, what's going to happen in 3 months, and what's going to happen in 3 years is always the market being unsure about the next story. So don't let the market tells you the story. Write your own with your investment thesis and a strong buy list on the side and pick those shares when they're ready. This is how you can enjoy a strong core portfolio that is already built, already generating dividends, and at the same time enjoy some macroeconomic events which creates market inefficiency. I hope that you really like this video. Keep those questions coming. I now have a lineup of videos, so I really find it very nice. Thank you for that. And until the next video, stay invested.